Think about what you could buy with this $20 bill even a year ago. And they want you to believe that inflation is getting under control. And you watch, I'm going to do a piece on this soon, on the countries that are dropping their interest rates to stimulate the economy. But conditions have been looser than ever. So we are still fanning the fuels of inflation. I believe, this is my opinion, that is a warning sign that we've already begun the hyperinflationary stage. And what they'd like is everything to go digital so they can control it, they can see it, all of that kind of stuff. But if all of your wealth is held digitally, in intangible assets, you get hacked, they can steal it, the markets implode, take your pick, you don't hold it.
Step into the shadows of the insurance industry with Lynette Zhang as she unveils a hidden peril. Beyond the facade of security lies a truth. Insurance contracts are only as strong as the entities backing them. From the housing crisis to the fragile state of life insurance and the looming threat of cyber risks, Lynette reveals the vulnerabilities that touch us all. With premiums skyrocketing and coverage dwindling, it's vital to grasp the impact on our financial well-being. Join Lynette as we navigate these choppy waters, arming ourselves with knowledge to navigate uncertain times.
Let's talk about a hidden danger, and I really appreciate the viewer that sent me this question and had me look at what's really happening in the insurance industry. Because people buy insurance thinking that now they're protected, or if they are insured, they feel a lot safer. But the reality is that an insurance is a contract, and any contract is only as good as the counterparty to that contract. And while insurance companies have been a stable, well, people consider them stable, well, that's okay, I can take risk because it's insured. Well, let me show you what's really happening throughout the industry that, quite honestly, has me pretty nervous and should have you nervous too. So we're going to start with housing because, frankly, housing is, on a global basis, a key supporter in global GDP. In the U.S., it's 30% of GDP. And there is a hidden crisis that is unfolding right now. And you might not even see it unless you are in a state that is impacted by this. In places most prone to wildfires and hurricanes, state insurers of last resort are absorbing trillions of dollars in risk. Why? Because insurance companies are moving out of those areas. And if they don't do something to change that, well, then people don't move into that area because they can't even get insurance on their house. So states have turned these plans into a magic hiding place to disappear risk that just gets too big for the private market. Did you hear that? States have turned these plans into a magic hiding place to disappear risk. So you don't even see it coming. But ultimately, who is responsible? It's going to be the taxpayers. With the state-sponsored insurance program backstopping real estate transactions in the riskiest areas, more people have moved in. This population amplifying loss potential, as the study calls it, rose more than 180%. In the end of the day, one way or another, it's coming back to taxpayers. So you might not even realize what's going on until it's too late. What are you doing to protect yourself? I mean, there are a lot of ways, especially if you're now, the bug out location that I have, fire is a big issue. So we do a lot to mitigate that risk. The house itself is made of metal. So even though it's lived through a fire, thank goodness, it's because we're doing as much as we can to protect ourselves. What are you doing if you're in an area like that? But the home insurance market faces unprecedented carrier exits and restrictions amid soaring premiums. So you're paying more, but frankly, you're getting less. Now, take a look at this. This goes through March, U.S. home insurance, quote, declinations. So that means that you're applying for home insurance and you are getting declined. at the same time that the cost to renew is growing. And isn't that true with all insurance? I mean, we all can see that. You are paying a lot more and getting a lot less, which is why the states have to come in to backstop and support this. But a record level insurance rates impacted mortgage eligibility for borrowers, with 68% of lenders indicating that home insurance caused an issue related to a borrower's debt to income ratio, DTI ratio. So the premiums going up, so your ability to get insurance is going down, your premiums are going up, that pushes you into a higher ratio and you can't even get a mortgage. Do you see the problem? Because it is coming. And real estate in the U.S. at 30% of GDP, they don't want to impact the houses. So the next insurance that we're going to look at is life insurance. Life insurers face their own unrealized losses on long-duration bonds after U.S. interest rates climbed. That's no small matter. Oh, and I put away my sterling silver chopstick. But that's no small matter, as the entire insurance industry managed an aggregate of more than $2.8 trillion in bonds at the end of 2023. Why? All right. When you take out an insurance policy and you're like, okay, well, I have a fixed rate annuity or something, or a life insurance policy or something that's supposed to pay out at a specified time, some point in the future. And then the insurance companies buy bonds to meet those obligations. But remember, we had 15 years of zero interest rate policy, ZIRP. And remember too, as interest rates go up, the market value of those bonds go down. So what do you think about the insurance company's ability to pay these out? Any contract is only as good as the counterparty to that contract. So what you're looking at here is the level of number of insurers with negative valuations. And you can see how this is spiking as the aggregate is going down. The bank estimates that roughly 1/3 of insurers had aggregate IMR losses as of Q3 2023. The longer-term average is 15%. So it has more than doubled. These are insurers, and it impacts their ability to provide those guarantees. Though that's what we're looking at here. That's a big problem, wouldn't you say? So you still feel safe with your life insurance, your fixed rate annuity, because there's a big problem underneath, and you aren't going to know about it until it's too late. This can insure it, even if you don't want to liquidate it, right? If you want to maintain your position, you need to be properly protected. So if that goes away, you still have. Think about what you could buy with this $20 bill even a year ago. And they want you to believe that inflation is getting under control. And you watch, I'm going to do a piece on this soon, on the countries that are dropping their interest rates to stimulate the economy. I've been saying forever, the central banks are between a rock and a hard place. They're trying to fight the inflation, create unemployment. But are they really tightening? Okay, they're allowing their balance sheet to run off, but conditions have been looser than ever. So we are still fanning the fuels of inflation. And according to the monetary velocity, I believe, this is my opinion, I believe that that is a warning sign that we've already begun the hyperinflationary stage. Less coverage, surging costs, oh goodness gracious. U.S. tells health insurers to relax the rules because we are in a different world. And what they'd like is everything to go digital so they can control it, they can see it, all of that kind of stuff. But if all of your wealth is held digitally in intangible assets, you get hacked, they can steal it, the markets implode, take your pick. You don't hold it, therefore legally you don't own it. This, you hold, you own. No counterparty risk. Everything I'm showing you here is counterparty risk. Lifting the rules could speed access to care for patients. It would also add more uncertainty for insurers that have a harder time gauging their expenses because of the hacks disruption. So insurance companies also have to take on insurance for cyber. Global cyber insurance, and they're counting on reinsurance companies, which limit the losses to the insurance companies, and that remains key to growth. The global cyber insurance market has recently returned to profitability following 2 years of rate increases and tightening terms and conditions. Do you read the fine print? Who does? They make it like a book, so you don't want to read it. And you trust them to have your best interest at heart. And I'm not sure that that's true. In fact, I don't think that that's true. Annual premiums reached about $12 billion a year at the end of 2022 and are likely to increase by 25 to 30% per year by 2025. Is your income going to increase by 25 to 30% a year over the next 3 years, 2 years, 1 year? 1 year. Yeah, we're in 2024 already. What am I saying? 1 year. No, not likely. S&P Global Ratings survey of global multi-line insurers and reinsurers suggests that growth in cyber insurance will depend heavily on reinsurance to provide capital and manage accumulation risks. We better hope that they don't go out. And by the way, reinsurance is a big line. Well, insurance and reinsurance for Warren Buffett. Huge. But let's take a look at the one that really, they all impact you. But I want to remind you, for those that feel comfortable and safe with their money in the bank, what you are looking at from the FDIC is unrealized gains and losses in securities. Now, I got news for you. This is what it looks like for the insurance companies as well. They have all of these unrealized losses. How safe do you feel? Because what's been happening, and I remember as a stockbroker, if an insurance company went under, another insurance company came in and absorbed them so that the public didn't know that there was a problem. Is that going to continue? I don't think so. Just like we're seeing a difference in what the banks are doing with the zombie corporations, and we're experiencing more defaults in the corporate bond market because the banks are just not wanting to or can't afford to hide those losses anymore. We're going to see the same thing in insurance companies.
Remember, knowledge is our greatest shield against financial uncertainty. But our adventure doesn't end here. Let's continue to shine a light on hidden dangers and empower ourselves with the tools to protect our financial futures. If you found today's exploration enlightening, don't keep it to yourself. Share it with friends, family, and anyone seeking to safeguard their assets. And don't forget to subscribe to stay tuned for more riveting discussions that empower and inform. Until next time, may your finances be fortified and your path forward be illuminated by the beacon of knowledge.